Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for May 2nd, 2022. We are recording this at 1 p.m. Eastern Time, and this is episode number 340. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today we have arranged for a solo option professor market outlook update episode. So I'm going to go ahead and turn it over to the option professor.
Okay, thanks a lot, David, and welcome everybody here on a Monday morning. We've got the markets down a little bit here today. And before we get started, just wanted to be clear on what we're up to here. We are going to be sharing with you our opinions and our observations on the markets, wide variety of markets. And we do want to remind you that this is for informational purposes only. Obviously, if you want to get advice, you would go to your brokerage firm and you would go to your broker who are more knowledgeable about your suitability and your risk tolerance. So today I'll be speaking about things that we think look good. But again, this is not advice. This is strictly opinion. Okay. All right. With that said, let's continue and let's go into what's going on. Today, I'm going to be covering quite a bit of the market. A little background on Option Professor. We've been in this investment arena for many decades, and we've done webinars and seminars on options, learning the uses and risks of options for decades. So we've educated thousands and thousands of investors. We're going to take that knowledge and experience and give our best shot on what we see, what's happening, review some of the things we have been saying, and go from there. Okay, let's start out with some base case going on. Again, our base case has been that in March 2020, that was a cyclical top in the bond market, and we're in a bear market in bonds, and pretty much that's what's been going on. In the stock market, our base case is that in 2021, we saw a peak in most stocks, and the stock markets are having a rather big, significant correction. We'll show you that it's still very possible in a bull market, but it is a situation where we may not stop right here. And we'll explain where we're coming from there. And then finally, on the commodity markets, we are a believer that we are going to be seeing, if not have already seen, the high point in the commodity prices. So that's our third point right now. So that's been our base case, and our base case has been, in my view, fairly reasonable. I think what we could do here is we could start out with the bond market because that's the one that's jumping here today. We've got the 10-year note and the 30-year bond and the 2-year note, pretty much all at 3% or better. And then we've got the 2-year note pushing up towards 2 3/4. Okay, so let's just take a look at the Treasury note here, and you get an idea of why we were thinking we were probably in a blow-off top in 2020 when I think it went to like 0.31% on the 10-year, something stupid like that. Yeah, there you go. You see this right here? That's February 2020 right here, March 2020. We went to about 0.31. Let's see here. Well, here they're saying the low was 0.39. Anyway, you slice it, it's under 1%, as you can see. And obviously, that's the Fed just totally easing and printing and easing to get us out of this lockdown that we had with the COVID. Obviously, they overdid it ridiculously. This is a 20-year graph. Can you see that's the lowest interest rate you can see on the graph? And since that time, the reality is that since they overstimulated, I mean, imagine putting $9 trillion on the balance sheet and putting that money in the consumer's pocket. And most of the consumers that got it have a history of spending all the money they get. So obviously, you got a very big move in the stock market with earnings going way up and the rates being this low. The only place to put your money was stocks during that environment. But look at these rates now, and they're getting up back towards 2018. Now, the question you have to ask yourself is, first of all, it's very overdone. Can you see the moving averages are down here and you're way up here? So we're way, way ahead of the Fed. So is it possible that these could pull back a little bit? I guess that is possible. But you got to ask yourself, do you think that controlling inflation where it is and the economy where it is, the rates can stop where they were at 2018 and accomplish that goal? And if you don't think that's the case, then you've got to start figuring that you're going to see prices in the 354 or 450 possibility, which would take you back to the 2006, 2007 range. And that's way up above 5. Now, could we get that high? We could. Realistically, is 3.5 to 4 possibly on the docket? That would be more like it was in 2010. At any rate, it's really going to be data dependent, and I don't know what's going to happen. And no, these people who give you, all these talks, they don't know what's going to happen. So the bottom line is you got to wait for the data to come out, and you've got to keep an eye on the market. And the bottom line is the data right now is showing a lot of inflation. The PCE report they showed last week is a very, very hot number. And that's why we're getting more of a sell-off in the bond market, because they can see that because they stuffed so much money in people's pocket, because their assets went so high in price, meaning their house and their stocks, that the wealth effect has not been killed at all. And ergo, that's why they don't know if we can hold this thing down at the 3% area, and that it might have more to come. So again, we have to watch the data. Now, the GDP did drop in Q1. It contracted, but don't forget those GDP numbers were going nuts last year, right? So the bottom line is that, and of course they could be revised. They're historically not that reliable. So at any rate, what's the story on the bond market? The bond market is in a bear market. That's why all these numbers are underneath the yield, and the yield is rising. Is it overbought up here? Meaning, has it gotten extended on a short-term basis? That's pretty obvious. Okay. Now, I'm going to be going over an opinion now. Okay. What do you do if you're holding on to bonds since March? What we've been telling people about is a couple of things right now. One is a laddered portfolio. And again, that's where you're going to have staggered maturities on a short-term basis. And as the money comes due, you reinvest it at the 2-year rate. So it's basically a 0 to 24-month deal. And if you started back here in 2020 with the ladder, you're constantly been renewing as it comes due monthly at the higher yield at the 2-year. And it would be a much more stable situation than if you're holding 30-year municipal bonds or 30-year corporate bonds or 30-year any kind of bonds, because duration is getting killed here. Okay. And even 10 years, that's a 10-year yield. And so obviously you could be seeing 10 or 15 or 20% or more losses on your bond portfolio. And people who have their money in bonds, they don't really want to be gambling with their principal. Yes, you could always hold these bonds to maturity and get your principal back if they do pay it off, and you get your income along the way. But the use of that capital, say you needed to sell some bonds for a purpose, or you needed that capital for a purpose, you would then be forced, if you bought your bonds here in 2020 or 2021, you'd be forced to take a pretty significant loss on your principal. Many people don't understand bonds very well, and that's why we do have a PDF report that explains how to work with the bond market in a rising environment. The other thing we're looking at is a ultra short-term bond fund. And in that, your duration or maturities are 1 year. And ergo, if you hold the fund throughout the year, despite the volatility, the principal should come up pretty well, because the duration is only 1 year. And the yield on that is getting to be about 2%. So that's an area that I thought was rather interesting as well, because your duration is only 1 year, and your income, while not as much as 3 or 4 or 5%, your principal is not going out the window at the same pace. So those are two areas that we talk about in the PDF report, and we get into greater detail. So if you have an interest in fixed income, that PDF report would be something to get a hold of. I'll talk about that at the end of the broadcast. Okay, so there's your bond market. That gives you a little bit of an idea, and that's on a 20-year long-term basis. And again, if you want to look shorter term, the 5-year, obviously, bear market, in other words, when this is rising, that means prices are dropping, okay, because it's an inverse market. On a 1-year basis, again, if it could get under 270 here, that would be an indication that maybe this thing is going to have a significant pullback. So look at the 272 area, that number here. If it starts getting under the red line comes in right now at around 286. So 286 and 273. If we started to see yields drop underneath there, that would be very helpful for people that are owning bonds right now. The relative strength index is well up here in the 50 and the 67 area. So that's why it's accelerating to the upside. Sometimes when RSIs are above 60, you get an acceleration to the upside. But, it is extended. There's no question about that. But again, there's no proof, no evidence here technically that it's coming down. Under 286 and 273, there'd be some more evidence. Looking at a 1 month basis, which is very short term, again, I said 286. So there's your 285 neighborhood. And then you see this neighborhood here at 273. So that's where I'm getting the numbers from. Okay, so that's your story on the bond market, if that's what you're into as far as part of your portfolio. And that's our view and that's our opinion. Okay, let's go back over to the S&P. We'll give you the stock situation. And then I'm going to be getting into some of the areas that people think there's a lot of possibility in, which is energy and fertilizers and shipping and steel. So we'll get into some of those in a little bit too. But let's go back here and get back to the S&P. Get back to the S&P. Here we are. Okay, so where did we get this idea that last year might have been the peak? Well, first of all, once it's this far away, we're at 4,800. And your moving averages on the 1 year is the 12 SMA is down here at this point, it was down at 4,200. So you're 600 points above. And then this number here last year, the 24 was down at 3,800. So now you're 1,000 points above. And then your 36 was down in the area of 3,500. So now you're 1,300 points above. And when you get this far above the moving averages, you tend to revert to the mean. And now you know what that means. All right. So that's why we were suggesting that getting into hedging or learning about hedging or finding out if it could be for you, that was the thing to do. We have no axe to grind, okay? Meaning we didn't tell you to buy a bunch of stocks, so we don't have to tell you that they're going up. We didn't tell you to short stocks, so we don't have to tell you that they're going down. We're just talking, we're like umpires. We're calling it as we see them, right? So that was our view. That's why we thought it was at a high point. If you look at a 5-year graph, you got a nice, once it broke under the red line there, which is around 46.65, that was a signal. And then, of course, it had this crazy rally up to 46.31. And then, of course, it can't hold it. So once it got right back above the 45.16 area, you're back in the soup. And now we're back in the soup again. The RSI is under 50 on the 5-year. And on the 20-year, you are RSI still above 50. So why are we saying that it's probably still a bull market, but it may have more wood to chop? Because the blue line has been rising, and it's been rising since pretty much 2010. So in 2010, it started to rise. It was tested. It got broken, but right above it, never turned down. Broke it, got right back above it, never turned down. Crash of 2020, got underneath it, boom, right above it, never turned down, and it still never turned down. So where are we here? We've got a couple of support zones to look at. One's at 40.36, and we're not too far from that one. And then if they let the bottom out and capitulate, it looks like 36.89. Maybe it'll get through that. I hope it does. If you're bullish and you have money on the sideline, if it gets through it, just be cool and then wait for it to get back above it. Because once it gets back above it, it's a good indication possibly that it's re-engaging in the uptrend. So if you had powder dry, you could bet with these other guys that the lows are in, although I think the lows are being taken out as we speak. But, or you can play the prices right and feel like, I think I'll be patient. I think I'll wait for that capitulation possibility. I'll wait to see if we get down towards that 38, 3,600 area, maybe even break it. And then if in fact that happens, gets back above it, you see, you don't want to necessarily be buying down here. Okay, you could, that's aggressive. And that the bet down here is that it's going to be, if you're buying at 2,200, that it's going to get back above it. And that bet worked out. Or you could be more conservative and wait for it to get back above it at 2,800 and you still got in for a nice ride. So again, that's the viewpoint here on the stock market, the S&P. Let's look at a 1 month basis. Doesn't look very good. On a 1 year basis, again, doesn't look very good. And on a 5 year basis, again, doesn't look very good. So you got everything working against it right now. And, if there was going to be, in the next 60 days, May and June, I would imagine that if they were going to smack it, that might be the time frame it would happen. And again, that would make sense on a lot of different fronts. One is that the Fed probably wants this thing to go down to a certain number where people stop spending so much. You can't get inflation down if everyone is spending their brains off. Okay, demand has got to back off. That's why a lot of people think we have to hit a recession. Why? Because in a recession, you're definitely going to get demand to back off. And then, of course, housing, which is inexplicable how they were buying mortgages not that long ago with real estate prices up 22%. And they're still buying mortgages. It's an insanity. So the bottom line is they're not doing that anymore. Mortgage rates are rising. And that realistically, if you've been around the block, anything that's dealing in borrowed money, when borrowed money goes up in price, those things tend to go down. Maybe not right away, but ultimately. So the bottom line is if they back off their real estate, obviously the stock portfolios are hitting the skids. And if the inflation remains a little bit elevated, I mean, maybe not at these levels, but it backs off to maybe 5%, that's still a lot of inflation. So that could get the consumer to cool it, and that could bring the inflationary numbers down a bit. Then, of course, if we get a little demand destruction or supply help on the oil, get those gas prices down, you got an outside chance of a soft landing. The Fed is obviously going very slow because they want the market to try to do their work for them, which the market is doing. You're at 3% on the 10-year. They're at 0.25% on Fed funds. Even if, hooray, this week they go in 0.5%, they're only going to be at 0.75. The darn 10-year and the 5-year, 10-year, and 30 are all above 3%, I'm sorry. And the 2-year is pushing 2.75, and the Fed's going to be where at 0.75. So what they're hoping for, I think, is that if they can kill the stock market a bit, kill the real estate a little bit, cool down that consumer, get the oil to come back down a bit, then they don't have to hike that much. And maybe there is a good deal on the bond market between 3 and 4%. Maybe those yields are good. And maybe the NASDAQ could recover if yields don't go as high as people think. I think that's what they're hoping to see. And again, that's not off the table. It could happen that way. That's the best case scenario. Okay, so that gives you a little bit idea on the S&P. So you want some lines in the sand, I put them in the newsletter. The lines in the sand right now, get above 44.26. I'll start worrying about a rally cap. You go down to 40.36. Okay, that's an area where it could stop. And then, of course, the better might be between 36.90 and maybe even 34.50 on an overshoot, and then get back above 36. That would be the really nice place where you might be able to get it. Because as long as the blue line is rising, I'm going to be still talking in terms of it's a long-term bull market still. Okay, because that's the evidence that I have since 2010, right? That's been the theme since 2010. Am I going to argue with a theme that's been going on for 12 years? So again, we could get a dump, but if it gets back above the blue, I'll be thinking that the dump was temporary. Okay. All right, let's talk about the Qs because a lot of you guys are in the tech sector and obviously you've been taking in a lot of water. So let's see what that looks like and get you some prices to hold on to. Okay, so again, this has already broken the red and the green. So now you're hoping that it holds on to the blue, and the blue comes in at 287. You're at 311, 312. So again, will there be an overshoot? There could be. There could be. Don't forget, all of this stuff to the upside, they were adding reserves and interest rates were at zero. Okay, that game has gone. We're not at interest rates at zero, although money market refuses to move for some reason. You know, you can buy a 1-year treasury for better than a 1% yield, and you can get a 2-year for almost 2 3/4. So that's not too shabby. And that's treasury now. So you're talking about the highest credit quality around. So again, Tina, you know, there is no alternative. That's kind of out the window a bit here. Okay. Again, the difference between dividend paying stocks and treasuries, that big gap that favored dividend paying stocks, that is now history. So that is a problem as well. So again, stocks are not as attractive when they don't have that big edge. And the big edge left when they said in November that they're shifting from what? Fighting unemployment, which they won, to fighting inflation, which I believe they will win because they have the power to make it happen. Okay, so anyway, there you go. Your RSI is still above 50, so I can still say that it looks like a bull market there, but we have to see where the lows are going to be. And we just look like we're making new lows here today. On a 5-year basis, doesn't look very good. 1-year basis, doesn't look very good. And on a 1-month basis, again, doesn't look very good. So there you go on your NASDAQ. There's some things to hold on to your hat. Getting back above 330 would be a positive. And then, of course, above 360 would be very positive. All right, now let's talk about the semiconductors. I mean, this one here, I mean, talk about wiping out equity. And this had a great story, you know? So, I mean, it's not like a company is losing money, but this is a classic case of valuations are changing. And that's why these people on TV, they're going, well, earnings are great. No, the earnings are going to be great. Look, their earnings are great. Their earnings may be great. Will they continue? Who knows? But even if they're great, they have to be valuated at a different multiple. So that's why I always have been saying in the newsletter, if we're going to earn $2.30 this year on the S&P, and you are going to get a 17 multiple, that's going to give you about 3,900 ballpark figure. If you're going to go to a 16 multiple, that's going to give you 3,680, which is where I think could be the low. And then, of course, if they squeeze it more, you know, because the pendulum as it turns generally doesn't, you know, stop in the middle, right? So it tends to go further one way or the other. So if they take the 230 and they crunch it down to 15 times, that's where you're getting your 3450. So these people who give you numbers like 3450 or 3680, they're not pulling it out of their ear. They're taking the earnings on the S&P and they're putting a multiple on them. Now, these guys that are looking at 5,300, they are putting a multiple of probably what, 22 on it? Yeah, 20, 23, or they're looking for earnings to be totally higher than what are anticipated. Anyway, this gives you an idea on why you have to be careful. And we always suggest you be careful when a market gets way away from its moving averages, because it tends to gravitate back to them. And that's a perfect example of what we've been talking about. And that's why our PDF report on hedging, which explains how using calls and puts as a hedge against your position can protect some of this value from going out the window. I mean, this thing's gone from 340 to 188. So just to give you an idea, in fact, it was above 340. The high was around 346 minus 188 divided into 346. I mean, the darn thing's dropped almost 50% in price. And this is a company that's making a ton of money. So at any rate, that just goes to show you when they revaluate the markets, everybody gets revaluated. All right. So let's go back to the more broad-based semiconductors and see if there's anything there. Okay. So on the semis here, again, if you could get back above 237, that would be helpful. Otherwise, you got to be prepared for maybe a 200 print. Okay, so get above the 237 would be a positive, and getting above the 268 would be a positive. And right now you're at 229. So again, the RSI is still above 50. So I'm, still on the camp that we're in a bull market there, but we're just having a significant repricing, moving it back towards the mean. And so you have to be prepared possibly, for some additional downside from here. But you have to be flexible in that if the numbers start changing, you have to start considering that as well. On a 5-year basis, where would it have to get back above? This red line pointing straight down is not a good thing. If there was ever one of the lines that I like to keep an eye on, it's the red one, because you can see the direction of that is where on a shorter term basis, you get your signals from. This thing turned down over here at 140, then it tanked. It turned up here at 120, and it rose and it rose and it rose, and it pretty much rose until it turned down at 300. And at 300, that was the beginning of the end of this thing. Even if you look at the S&P, you'll notice the same situation. All right. So anyway, there you go with the semis and the tech. That's where you go with the NASDAQ. That's where you go with the S&P. And that's where you go with the bond market. So I gave you a little bit of information to look at all those two as well. Now, what I'd like to do is take a look at the gold market. Okay. Because that is having some problems here. And let's see if these problems are something that could be corrected, or if this is about it for them. So here we go to the long-term graphs on gold. Gold's getting hit pretty good today, so this is a good day to take a look. There you go on your 20-year chart. Okay. You've got it rising here, and it comes in at 1737. So this thing could still drop $100 and it still would be rising on the blue line. That does look like a double high point right there, but that could be just deceiving. The 12 and the 24 SMA on the long-term chart comes in at around 1830, ballpark figure. So you're still above that, which is a good sign. Okay. Your RSI on the gold is right at the number of 57. So it's still above 50. That's good as well. So as far as the gold is concerned, if you're holding it, there's a reason to hold it. If you're looking for new highs right now, that right now is a rough racket. But again, your lines in the sand look, as far as what we're looking at, is 1737. And again, 1836, 1829. Okay. If you go to the 5-year graph, now it's being into crunch time, because you don't want this thing to be closing underneath 1842. And we're at 1865. Getting back above 1867 and 1929. See, I like the red line here. We got to get this thing back above 1929 if you want to be bullish, because the longer it now stays under 1929, the more the red line will start turning down. And as you can see, when it turns down, like in 2020, sometimes it goes way down. So again, it is still, up here, but getting this gold, I would personally, our view would be get it back above 1929 and then call us up. Because again, right now, yes, it's very much testing into some support. So if that's the way you want to play it, nothing against that. Keep it above 1842, get it above 1867. We can see that. Plus, your other long-term averages are 1829, 1836. Those are important. And then if the shoe drops, 1737. But again, if you're a shorter term trader, you certainly would like it above 1929. That would be comforting. On a 1-year basis, There's your 1940 numbers. Okay, so getting above 1929 would be a positive, and of course 1940 would even be more positive. So call it 1930, 1950. You'd like it to get going above those numbers, and that would open the door to all these higher numbers. Okay, but again, your RSI is not looking so good right now. This again is the 1-year graph, and you don't like that RSI under 50. Again, before the long-term graphs turn down, obviously the short-term graphs start. And this is a shorter-term graph with a 1-year chart. And it is starting to weaken at 44. I'll tell you this as a RSI, you're at 44. If this thing breaks under 40, you could accelerate to the downside. And that would put obviously 1829 into play very easily, but it could also put the other numbers in play. So watch that RSI. You don't want that underneath 40. Our opinion on RSI is when it gets above 60, you can accelerate to the upside. When it gets under 40, you could accelerate to the downside. Okay, so there's your gold. Silver is the one that's really looked the weakest. I'm giving you a little precious metal here, and then I'm gonna give you a little crypto. All right, let's get the future up here, and you could take a look at the future. SILVER. There you go. We'll go to the May. This lost a lot of altitude lately. This one was trying to go up. You see how it was trying to go up to 2650? And this was, you know what this was? This was a couple of weeks ago. And where are you now? Wow. So this thing gave up the goose. This one does not look good. Okay. And where would you have to get going for it to look good? Well, it's holding on to this one. So that's pretty interesting. It's, you know, and the line is moving higher. So again, if we could hold this 2182, that would be very helpful. And then getting back above 2425 would be very helpful. So if you start seeing 24 and 25, that might be a signal that this thing is going to hold down here and maybe you're onto something. There's a lot of real estate up here, 30, 35, 40, 45. So again, waiting for some strength to kind of see if this thing holds at 2180 and then get above the 24 and 25 mark, you know, and get that RSI. Now we're RSI on the long-term graph. I think it's right at 50. Okay, so the jury still could be okay on silver. As long as 2182 holds and as long as the RSI holds 50, it still could be okay. So maybe don't throw the baby out with the bathwater on silver just yet. Maybe this is a fantastic opportunity. We'll know soon enough. On a 1-month graph, when would it give you a little bit of a buy signal? Hey, you see getting above 23 would be helpful. See that 2360, that'd be helpful. And again, RSI is not really making, this is a big new low and RSI is, you know, right here at 35. Remember we were saying if it gets under 40 on the RSI, it could accelerate. Well, right here, your RSI was at, let's see, 47. And that's at 2340. So what happened once you got to the RSI under 40? Well, you went from 2350 and you hit as low as 2220. That's a good acceleration. And it's an example of why I'm looking at it like that. Okay, so there you go with the silver and gold. Let's look at that crypto. There's another nightmare on Elm Street for people who don't, you know, get too tied up with the hype and don't keep a look at the graphs. Here is Bitcoin. And we are going to go out to the, I don't think they got a good 5-year graph here because it only goes back to 18. So let's go to 5-year graph. All right. So as you can see, the red line is very important. You know, again, it turns up here at $10 and gives you a ride all the way till it turned down here at about $47. That's a pretty good ride. Then it gives you a pretty good ride all the way down here to about 30. And then it goes up and gives you a ride to 45. And now that ride is continuing down. And so we need to get GBTC, which is your Bitcoin trust. We need to get that baby above 28 bucks. And once it gets above 28 bucks, it has to get above 30 bucks and then it has to get above 35 bucks. And again, that blue line is indicating that this thing is going to be languishing downward for a while. RSI is under 50. That's not a good sign. So we're not so keen on Bitcoin right now, but if it got above 28, we'd listen to people. Got above 35, we'd consider that pretty significant. And then it would open the door for all these wonderful numbers that they talk about on TV. Talking about Ethereum. And Ethereum is pretty much the same idea. Had nice buy signals down here at $6, rode it all the way up here towards around 26, pulled back to 22, back on the bicycle till 38. Down off the bicycle, had one little rally. This looks a little bit like that 46.31 rally on the S&P, right? One of those sucker rallies, and then back down again. So getting above 22.67 would be positive. Getting above 30 would be wonderful, and that would open the door to all these wonderful things people talk about. So again, there's a couple of places to keep an eye on. The red line is very important, as I always say. So keep an eye on it. And that's your first signal, which would be getting above 26 bucks, 23 bucks, 22.60. Okay. So that's what your Bitcoin and stuff looks like. Let's look at the Goldman Sachs index here. Hold on here. Yeah, this is the Goldman Sachs Commodity Index. Now, remember how we showed you the graph on the bonds? Clearly, they made a top in price and bottom in yield back in 2020. Remember 0.39 on the 10-year? Now we're at 3%. You think it's risen a little bit? Come on. That's a pretty bearish situation. How about stocks? 4,800. Now we're pushing $4,000. That's pretty bearish. And you look at that NASDAQ and look at some of those stocks like what? NVIDIA used to be the catch me out at 346. Now you can get it all day long at 180 and change. So again, here's where we're coming at on the commodity sector, which we said is the third shoe to drop. And here's where we're getting that from. You see this here? This is a high point in 2008, and this is a broad-based commodity index, which has oil in it, metals, grains, and of other things as well. But those are the three main areas. All right, so can you see this index peaked out here in 2008, and the number was about 890, just a shade under 900. Okay, then look what it did. Went all the way down here to 2009 during obviously the crash of 08. And we went all the way down to as low there as around 300. That's a pretty good drop, huh? Then we rallied up towards 800, and then it went back into the tank. Look at the red line up there, got out. And again, when it gets way away from the averages, it'll come back down toward it. Okay. So, and like, say you thought this was overboard and you said, I don't want to be involved in it anymore. And so for a couple of months, you had to hear how stupid you were, right? And then what? After 4 months, you were a genius. So again, sometimes, they don't go right back to the mean, but the probabilities are there and the odds are there. And the higher it goes, it doesn't make it less overbought. Okay. So, just try to remain sane in the insanity sometimes. Same thing down here. You're way down here. And so basically you say this thing's oversold. It's going to come back towards its averages. You're wrong for a month or two, but ultimately you're right. All right. So anyway, you went to about 900 here. We just had a parabolic move in commodities. You know that. We went to 850. Can you see we're now at 747? So we're not at 850 anymore. And it's failed to take out 900. Now, could it go to 900 and 1,000? If we have a parabolic move in commodities, yes, it could do. And if we're going to have hyperinflation, of course it can do that. If you want to bet that way, God bless you. That's not the way we're thinking. Okay. We're waiting for a little bit more price evidence, but our instincts are this thing is peaking this year. Would you be shocked if that's the case? I don't think so. All right. So there's your price evidence on what we're coming up with. This idea, we're not pulling it out of our ear. Okay. All right, so there you see it. Now let's look at some of the things that are involved with this thing. Crude oil, right? Let's see what that looks like. Now, one thing about commodities is, they go through cycles, right? One is you'll see a cycle where, um, what do you call it? Where there's no supplies, right? Or there's a geopolitical event. Okay. Next thing you know, there is supplies. All of a sudden there is no grain. Next thing you know, they're planting a lot of grain. So it goes through different pushes and pulls. So anyway, on the crude, on the 20-year graph, still looks very positive. But again, the averages are down here at the 80 area and the 60 area. Okay. And, RSI right now is right at what? 62. So again, when you're at that 60 neighborhood, I mean, if it's going to go to 70 and 80 on the RSI, then this thing is going to make another parabolic move, and we're going to have a very big energy crisis going on, much more than we're seeing now. But that does look a little bit like the Space Needle. And if that is the Space Needle, either A, it might have one rally to try to test it, or that could be it. So we'll have to see. If you're looking at things on a 5-year basis, let's take a look. Again, as long as we can hold above here at 86 to 105, 86, 90, 105, you're still okay. RSI right now is at 60. Again, very key point, this 60 number, 62, 60. If it's going to go 70 or 80, you're going to go parabolic here. Okay. And that could be a great thing for these energy stocks, which we'll look at in a second. Let's look at a 1 year. Okay, a little bit more dodgy. Can you see it? Like the red line right now. If this thing starts closing underneath 103.44 and then underneath 101, basically look at the 103 number at 101. If it starts closing underneath 103, 101, and the RSI is at 54 and it starts getting under 50, that's going to be your first signal that this thing is done. So right now, it still is set up that it could have a parabolic move to the upside. Absolutely. But again, you see how extended it got, right? And you can see that it's been chopping ever since, not making new highs. As a matter of fact, if you look at the high, the first one there is above 120, then a little bit above 110, then under 110, then under 110 again. So the highs have been getting a little lower. So if you do see a break under 103 and 101, then, and then of course 100, these things could turn down. RSI could break 50, and now you're in the soup. So be very careful with regards to the energy, because it looks like it's kind of on a ledge a little bit right now. Again, we are entering the summer driving season, so demand should be quite high. If the powers that be want to see inflation drop, I don't know that a oil crisis and summer driving season is the combination that'll make that happen. So I'm sure the powers that be would like to see a break in this market so that the demand, so that the inflation can come down. And then, of course, the interest rates going up will quell the economy, because our economy is based on borrowed money. Everybody's leasing cars. Everybody's buying houses with 10 and 20% down or less. Everybody's trying to do refis or whatever, take money out. Okay. And the higher the interest rate for all that activity, generally, I would expect the lower the activity. So I think that's what they're hoping for. And I don't think an oil crisis is in the cards if that's what they're trying to get. But, you follow the numbers, right? And if we can start sustaining prices either above 104, 105, 106, 110, then this thing's off to the races. If you start sustaining sub 100 prices, then it could be a thing of rolling over. That's why you got to be careful right now in energy. Okay, so I gave you a little bit of a tip on that, and then the gold, and then let's take a look at the grain activity with soybeans. They were getting hit pretty good today. Let's see what they look like. Okay, as you can see here on the soybeans, looking at the 20-year graph, this is very overbought, right? And your RSI, look at that. You've made a big high up here near 18 bucks, and the RSI did not make much of a new high, because there's the high on RSI at 68, and then you've got it here at 65. So you made a big new high and not a new high on RSI. That's a bit of a divergence. Okay, and today, what are we down? Now we're down 39. So again, And you see where the highs are here. Former highs 18, right? So you tried to make a new high at 18, hadn't happened. So if we're going parabolic on the commodities, then again, stay with them. But would this be an area where taking a little bit of a more careful approach might make sense? It might. It very well might, simply because it's very far away from its long-term averages. With these prices, you would imagine everybody who could plant anything would be planting. And we'll have to see if rain brings grain, right? Okay, so let's take a look at a couple of stocks here that people are kind of keen on here and see if there's anything happening here. Devon Energy, everybody loves it. Let's look here. Again, very great move, $10 to 70. I mean, you can't beat that, right? But it is very overbought. The high recently has been 65.50. And so basically, if you didn't think there was a parabolic move going to 80, 90, or 100, up here would be where you might protect some of the gains if you've been in there since 10 or 20. And a couple of different ways of doing it, which is on the PDF report, is through collars, married puts, and replacement trades. All of these might be considerable, because if oil were to break under 100, I would imagine Devon Energy would get a negative impact from that. Another one everybody loves is Chevron. CVX. And let's see what that looks like. Again, big high point made up here at about 175, currently at 158. Okay, so, if it goes to 175 and you see the moving averages are up here, you could do some hedging up here, using 180 or 190 as a striking price, and then try to maybe buy some puts underneath with the premium if you'd like. There's a lot of different ways to go. Again, on the PDF report, we go over a bunch of different examples. Again, these are examples. You talk to your brokerage firm, you talk to your broker, your accountant, everybody else, and then find out if it's right for you, risk tolerance wise, tax wise, the whole 9 yards. So that's why we're not giving advice on this stuff. We're explaining how things work. Okay. Let's talk about, so there's two. How about in the fertilizer? We got CF Industries here. They've had a big move. Again, big move up to 118, 115. Now they're at 97. Very far away from their averages. How about Archer Daniels Midland? Great company, been around forever, but the trees don't grow to the sky for anybody. And this thing went up towards $100 and now it's at 88. Okay. Mosaic. And this one went to 80. Now it's at 61. You're getting the idea that we're getting the feeling that maybe the commodities might have peaked. You know what I mean? You're getting the idea a little bit here. Okay. Let's start looking at some of the, now a new one that people are talking about is the South American one on oil. And this one here, that one doesn't have the moving averages on it. Hang on. Let's go back. But again, if the energy drops, they're all going to drop. That'll be the end of that. Okay. Let's go over to some of the steel companies, like infrastructure is supposed to be real big, right? Now this thing looks like it could be good. You got the red line coming in here at around 26.5. It's at $29. If this thing can stay above the 26 and keep this moving average rising, keep an eye on it. So that number of 26.5 is very big. Same thing with Cleveland Cliffs. Got to keep an eye on that. We cover a bunch of these in our stocks that we think look good, our opinion on different sectors. So in the industrial metals sector, Cleveland Cliffs and U.S. Steel are two that we keep an eye on, as well as Vale and a couple of others. Let's just take a look here at Reliant Steel, RS. And on Reliant Steel, again, very overbought, very much looks like it could have a pullback here. So you got to be careful here. That's why, again, if you do replacement trades, it keeps you in the market with a call spread, which has limited risk on it. So if this thing drops $60, but you only got $5 in the spread, obviously your risk is limited to the $5, and the other drop you could not be involved in. Same thing with NVIDIA and all this other stuff. That's why, not any strategy is correct for everybody, but knowledge about strategies is pretty good across the board. Okay, let me just see here. Another fertilizer company, ICL. Again, as long as this thing stays above the number of about $9, at least it's still above the red line there. A couple of shippers. Star Bulk. That was trying to get going and it's still hanging in there pretty good. You want to keep this baby above 24 and have that red line start rising and rising and rising. Another one is Zim. And again, this is a newer company, so you got to be careful of it, but that's, showing some bid. One area that we were thinking is supposed to be so great is this return to travel, right? So we take a look at jets and try to get involved in the airlines with one-stop shop. But you know what? We're not seeing a great situation trend-wise here. We just want this thing to remain above 21. You see this? We needed to get above 22 to get this thing moving. Right? And it's getting underneath the 21 area. That's not good. So, travel is supposed to be this big thing. Airports are full, planes are packed, but why isn't this thing going? That's not a good sign. But if you're starting getting above $22, yes, above $24, absolutely. So keep an eye on jets if there's going to be a reopening deal going on. The other one is this company, this ETF called Away, which gives you a one-stop shop on all types of travel. I think they got Airbnb in here. They got Expedia or Booking. They got all kinds of companies. Again, they need to get going above 23 and 25 if they're going to be going anywhere. And they're having a hard time doing that. So the hotels and other stuff like that, they're also having some difficulties. And finally, we thought Hertz might be something to look at. Rent a car, right? So that was going pretty good and it's still hanging in there, but it's losing altitude again. So again, we need these things to get going for us to get bullish on the reopening trade, because we're not just going to go in there because a bunch of people on TV are talking about it. We want the prices to be confirming the movement, and then we're more than happy to join the party. But we don't want just a bologna sandwich when we go to order our food. Another one is Las Vegas Sands. At some point, they will be opening up China, and they're going to take that tape off the doors where they're taping their residents in. And those people are probably going to be like our residents, fleeing to where they haven't been able to go for a long time, and taking chances in Macau is one of them. So we are very much waiting for this thing because we think there's a very bright future, just like in the other travel area. But we're not going to get in there just to see our account drop every day with some story that makes sense mentally, but financially is not doing any good for us. So get this thing back above 40, and then we could open up the door to 45, 50, 55, and 60. But you can't open the door to those numbers unless you get above these numbers, right? So we're watching that for some clarity. Of course, MGM gives you a little bit of Macau and a whole bunch of Las Vegas, and that has been trying to move up. But again, this is on the defensive as well. I mean, and we go back on a 20-year graph here, and you can see it is in a bull market still, as long as it stays above $32. But 41 to 32 is a pretty good ride. I don't like that it's under the red line here, which is at 42.50. So bottom line is let's get above 42.50 and 45, and that can open the door to all these other wonderful numbers up here. It does look like a long-term bull situation though. And that's a reopening story as well. So give you a little bit of an idea of all the different stuff we're keeping an eye on. And basically, we've got these PDF reports we put together to try to help people get the information that we have and our opinions that we have all in a condensed format in a PDF report. In these PDF reports, basically, you've got one, hedging, upside and downside risk. What does that mean? That means if you are looking at some of these stocks that are very high, like the energy stocks, and you want to protect your gains, you do a hedging strategy to protect against the downside. There are strategies for that. What about the guy who's in NVIDIA at 350 and he is going nuts every night, flipping and flopping because he doesn't know where it ends with NVIDIA? So he's going to get out because he can't stand the heat. Well, rather than just getting out, maybe he should look at long-term call strategies, a year or 2 years out with limited risk. So that if the thing does turn around, he's still got a position going, but he at least calls the dogs off that have been biting at his legs for the last 6 months. That's another strategy. So we got hedging for you. We've got how to deal with a rising interest rate environment. Okay. We also have got our best ideas by sector on all the different sectors, which include what? Value, growth, innovation, metals, precious and industrial, energy, both crude oil and nat gas. We've got some nat gas stocks that are very interesting because there's supposedly be a jump in nat gas in the fall. I don't know if that's going to happen. It is in a bull market. What else is out there? You've got staples. You've got utilities. You have got materials and industrials. And by sector, we've broken down what, in our opinion, are some of the best stocks in each sector. Cybersecurity, a lot of people are looking at that, as well as cloud computing. So we've got that broken down as well. So you've got hedging, up and downside risk. You've got the situation of the best in each class. We also have covered call writing, where you go 15 or 20% above the market and try to protect your cost basis. And then we explain how you can roll things down, roll them out, roll them up from where you start. So again, many of you are out there and obviously you're trading on your own. So you're trying to educate yourself. We've been doing this for decades and we've done seminars, hundreds and hundreds of them to thousands and thousands of people. And again, we go over the risk and the features of each strategy. It's not just a one-way street. And again, we only try to go with what we're being seen. So, you know, a lot of people would not say that the bond market peaked in 2020. They kept saying that rates can't rise, rates can't rise. Well, obviously they can. And a lot of people were thinking, we're just having a pullback here. Look at those earnings. We got a strong economy. The consumer and the corporate balance sheets are fantastic. That's wonderful talk if you have a cocktail in front of you, but it's not very good when you go to look at your statement every month. And that's what we're more interested in. You know, are these things uptrending? Can you hold on to them and have a reasonable expectation they may rise? And that's why we go over, you know, different technical indicators, because one of the other PDF reports are on the technical indicators that we use to come up with these opinions. So these PDF reports are very helpful. I think they're very educational and they're easy to get. All you need to do is you go to optionprofessor.com, OPTION, professor, PROFESSOR.com. You put in your contact information, include a valid telephone number, and then we will contact you and explain how they can get sent right to your inbox. Now, here's a special deal we've got today. With the PDF reports, you also get a situation where we have a 30-minute dialogue where you can ask questions and you can get our opinions on what your questions are if we have one. And we also share with you, again, how we use our technical indicators to try to figure out if it's going up, down, or sideways. So you get the PDF reports and you get the 30-minute talk, a question and answer back and forth. You're on your computer, we're on our computer. We look at stuff together. We try to come up with some kind of an idea of what our opinion is. And then basically that's part of the information that and research that we are providing. Okay. So again, we do look forward to hearing from you. Again, these reports are, in our view, very, very informative and would help the vast majority of people that we speak to or are in contact with. Many, many people have gotten the PDF reports and they have thanked us very well because of their balance and information, which people are looking for. They'd like some information that's based on reason and they'd like it to be balanced. That's what we provide. Okay, so again, it's optionprofessor.com, and then basically put in your information and we will be more than happy to get this to you and provide you updates as well through our weekly update letter that we put out. And of course, you'll be eligible to get that as well when you put your information in. All right, this is the optionprofessor.com. It's the top of the hour. We have a big week ahead of us. I'm sure there's quite a bit of action to be had. Do go to the website, optionprofessor.com, and get your information in, and then we'll talk to you then. Until then, good luck and good trading, everybody. And we'll be talking to you during another broadcast. Have a good day.